Okay, ladies and gentlemen, welcome to Macro Ace with your host Tony, going through non-farm payrolls and the Canadian employment change data for the data for July. So we've got quite a bit to cover. Hopefully you can hear me nice and clearly and there's no issues with the sound or the screen. Do let me know if you do have any issues and I'll try and sort it out. But we do have a little bit to get through. Not as much data or sentiment to kind of go through with the Canadian employment change data. More or less quite simple. But let's make headways then. So non-farm payrolls then. So what is non-farm payrolls? So it is the net amount of jobs created in the prior month. Also, just a reminder for everyone who is now watching this live stream, if you could kindly share it with your friends, fellow traders that would be interested or could benefit from knowledge about the economic release, then do share the link with them. It's no sign up is needed. All they need to do is click on the link, press play, and then they will be here with us. So if you could do that, that would be nicely appreciated. But as I was saying, getting back to the prep now, so non-farm payrolls, the net amount of jobs created in the prior month, it doesn't show you how many jobs were lost, which the JOLTS data does in the following month for the data. So we only get the net amount of jobs, but that's what traders care about, and the reason why it has a lot of significance is because it measures data from the prior month just gone a week after. So a week after the prior month has ended, we get non-farm payrolls data, the amount of the net amount of jobs that are being created with the economy. Now remember, that doesn't represent how many people have actually taken up those jobs, it just represents how many jobs have been created. So we have different surveys then, or parts of the non-farm payroll survey that kind of combined together into one report. So we have the household survey, which is a consensus or is an interview via the phone or email that's given to different people around the country, asking them whether they're employed, part-time, full-time, the hours that they're working. That's where you get the household survey data from. The unemployment rate is where you get the household survey data from. Then the establishment survey is where you get the net amount of jobs that have been created. So that's measuring or querying 440,000 different businesses in the US, small and large, that just asks how many people they have on their payroll, whether or not they're part-time or full-time. And then and then they just take the number of people that have been added to the labor force or the number of jobs that have been created from that, and then turn that into the final figure that we get on the Friday. So that is the establishment survey that we get there. So that should help you understand if you do look through the report itself, then you're looking for the establishment survey data that will give you a very good indication of where the economy could be headed in regards to the labor market. Then if we kind of go on to how does it affect the markets then, so it's quite simple. When we're in a normal trading environment, when the central bank isn't looking to raise rates or tighten monetary policy for the currency, as always, a good non-farm payrolls figure would see an appreciation in the dollar. And we would see, of course, that would be because there'll be more confidence that the US is creating more jobs. Of course, if businesses are able to do that, there's more confidence in the economy itself, that productivity will start to pick up soon as well, and that people have more money in their pockets to spend as well. So for the currency, a better than expected non-farm payrolls figure is really good for the currency usually. And for stocks now, when there's no tightening environment from the central bank, or in this case, of course, the Federal Reserve, and they're not looking to raise rates for stocks, if you do get a better than expected figure, then that can be bullish for stocks. But when in the tightening environment, and one of the recent market reactions that we've seen, when we've had really good non-farm payrolls data, we've seen the opposite happen. So because traders or stock traders fear that will lead, a stronger jobs report will lead to a better economy and will lead to the Federal Reserve taking tighter monetary policy. In actuality, you see stocks see a move towards the downside instead, or depreciation from what we've seen in the past. So for stocks in this current tightening environment, If you do get a better than expected, much better than expected payrolls figure, then you could see some movement towards the downside in the stock indexes. Then for bonds, for bond prices, and bond yields, either way. So one thing you've got to consider is that if the economy is doing really, really well in a normal environment, people tend to go to riskier assets such as stocks and foreign exotic currencies or commodity-based currencies, and they will move away from safe haven assets such as US Treasury securities or bonds or government bonds, basically, right? Now, when you usually get a better than expected figure, what happens is that the bond prices see a move towards the downside, and the bond yields and the bond yield goes towards the upside. The reason being is that the government tries to attract those investors to invest in their government bonds, knowing that, of course, if the economy is picking up really well, there's not really going to be that many people jumping into bonds if they can make more money out of the stock market. Within a tightening environment or tightening cycle, of course, if stocks could see depreciation when you do get a better than expected payrolls figure, then bond prices can still go down and bond yields can still go higher, because that, again, it's the same thing. It's the Federal Reserve that can continue to aggressively hike rates and tighten monetary policy, and that will lead to the short-term bond rates seeing bond yields seeing a big appreciation, and the longer-term bonds see a bit of an appreciation, but everyone jumps to the smaller-term bonds because that's where the Federal Reserve has the most control and most effect in the bond market. So when they start raising interest rates or tightening monetary policy, the short-term bonds, like the 3-month or 6-month bill, start to see a bigger appreciation in their yields and see a depreciation in their price, or bigger depreciation in the price compared to long-term bonds. And then that's when people start talking about the yield curve inverting, when short-term rates are much higher than long-term rates, which is one indicator, and I say one indicator, of an economy heading into a recession or a downward or very strong downward trend. Well, basically a recession is what you can say. So gold, somebody said gold buys to the moon, Bob's Burgers. Hey, will we see a Dixie sell-off? Afternoon, lads, says the engineers. Kurt B says, hey guys. Hello, everyone. Unfortunate says hello as well. Hello, everyone. I've just kind of turned my eyes to you guys in the chat. But yeah, so for gold, now remember, intermarket correlation wise, okay, very, very simple. When the dollar sees an appreciation, gold will see depreciation. Of course, when you have a stronger dollar, it's easier to buy gold because gold is measured in dollars. So the stronger the dollar is, the weaker gold becomes. So that, again, if you do get a strong payrolls figure, and we've seen in the past, we'll look at the deviations, you can usually see depreciation in gold when you start to see the dollar fly up in the air. So that's how it affects the markets. So then if we're looking at the indicators that are weighing on sentiment at the moment and where the economy is as well. Now, the CPI, of course, at a fresh 40-year high at 9.1% year on year versus the prior of 8.6%. The PC price index year on year also was higher than expected, was higher than the previous at 6.8% versus prior of 6.3%. Core PC price index year on year was at 4.8% versus the prior 4.7%. GDP's second quarter advanced data came in a contractionary area again at minus 0.9% versus the first quarter data that we had, the final first quarter data compared to minus 1.6%. So the US economy is still in that contractionary phase GDP-wise, and the unemployment rate still stuck at 3.6% above the 0.1% above the pre-pandemic level. That's been like that for a very, very long time. We haven't really edged down with the US unemployment rate for a very long time. And then the ISM Manufacturing Employment Index, which we recently had this week, so it showed an increase at 49.9 versus a prior of 47.3. So employment in the manufacturing sector was seeing a bit of a pickup Now remember, any number above 50 shows an expansion within the economy, and any number below 50 shows a contraction. Remember, it's a survey of purchasing managers, the guys who are at the forefront of buying the goods that they need or raw materials to create the goods to then to provide to the people who sell it as a business, and then it goes on to consumers. So if they're seeing, it's a measure out of 100, 0 to 100, right? 50 being half and half. Yeah, the economy is doing well, and it's doing okay. Anything below 50 shows a contraction, that the economy is not doing well, or the manufacturing sector isn't doing well, should I say. Initial jobless claims this week was at 260k versus prior of 256k. We have the US JOLTS job openings, which had 10.698 million versus prior of 11.254 million. Remember, JOLTS represents the amount of jobs added, jobs added and lost as well. So people who were laid off as well. So that's one thing that we've also got to consider too. Alrighty, so if we carry on then, let's have a look. So the employment cost as well, showing 1.3% versus prior of 1.4%. Now, the triggers for the economic release then. So I've given you a bit more detail, but we'll look at the deviations too. So the highest estimate, according to economists, they see a high estimate of 325k, and that would be a 75k deviation from the median estimate, which is 250k. When they see a low estimate of 50k, well, that should be a 200k deviation rather than 50k deviation. Apologies there. But yeah, so they're saying a 200k deviation on the low end or the lowest estimates for non-farm payrolls. The unemployment rate with a high estimate of 3.8%. And a low estimate of 3.5%, because of course it's been stuck at 3.6%. So they're expecting a 0.2 deviation on the high end and a 0.1 deviation on the low end. Average hourly earnings forecast a highest estimate of 5.2% with a low of 4.7%. Of course, median estimate is 4.9% for average earnings year on year, and that would be, of course, a 0.3 deviation and then a 0.2 deviation on the low end. Private payrolls with a high estimate of 305k and a low of 40k is a high and low estimate. Of course, median estimate that we have for the private payrolls is 230k, and then and if we carry on going, then we look at the investment bank views. So JP Morgan with a forecast expecting non-farm payrolls to come in at 200k. With the unemployment rate to remain at 3.6%, as all these other investment banks are expecting to. BNP Paribas expecting non-farm to come in at 280k. So they're expecting a 30k deviation towards the upside there. Of course, JP Morgan, a 50k deviation to the downside. And then Bank of America expecting 275k, so a 25k deviation towards the upside. But again, as said, everyone's expecting 3.6% or the unemployment rate to remain unchanged. Now, the previous report as well, so the service sector recovery continued in June despite a small slowdown in goods sector employment growth. Private sector job growth accelerated, so 333k versus 278k, primarily in education and healthcare, 96k versus 57k. And although retail employment recovered around 15k of the 44k jobs lost the previous month as well. The leisure and hospitality sector added 67,000 jobs, somewhat more than the previous 2-month average. So the key thing to remember here is that hiring is still strong within the US. And some people are saying, well, the GDP data that we had for the second quarter shows that we're in a recession. But not yet. We've still got remember, can't take one indicator as an indicator that, yes, the US is in a recession. Remember, the GDP data is old data, right? That's compiled together over, 3 months. So we've got, there's a lot of economic indicators between that time that will show whether the economy is really slowing down or not. So we have the ISM data, non-farm payrolls today, of course. You've also got of course, where the unemployment rate is. How's the housing situation in the US as well, or within any country or any nation? Are we seeing delinquency rates skyrocket or start to creep up higher? Those are the kind of things that we have to consider. That's why it's a tricky thing to say, yep, we're in a recession. I know a lot of people on Twitter don't believe Yellen or the Fed guys saying we're not in a recession yet, but I somewhat agree. We're still getting solid non-farm payrolls data or job creation, which more or less is at the high point of the US economy. If jobs are still being created and we're getting a decent amount, around 400k or so, then the economy is still trudging along quite well. And the Federal Reserve will try to find the fine balance between hiking interest rates and then keeping not hiking them too much to cause a recession from hiking interest rates too much. So we're yet to kind of see the implications and the effects of that. We haven't seen that yet with the non-farm payrolls figure with the previous rate hikes that we've seen so far from March up until now, or from July. So we're yet to kind of wait to see what else we get from the Federal Reserve and how they affect not only the market but also the economy as well. Now, Fed and government views. So you had Fed's Waller on the 29th of July saying that a soft landing is a plausible outcome for the US labor market. Fed's Powell said the overall labor market suggests that underlying aggregate demand remains solid, i.e. there's a tight labor market. There are a lot of jobs being provided, but there aren't enough workers to kind of fill those positions. Treasury Secretary Yellen on July 14th said the US labor market is very strong, is in good shape, and supportive of the Fed's efforts to get inflation under control. Remember, if the job has been created and we're pulling more people from the workforce into those jobs, or putting more people out of unemployment into those jobs, then those people have money to spend. And if there is the same amount of goods that's within the economy, that of course will lead to higher prices. Or if there's more people that have more money to spend, that will slowly add to inflation, or quite quickly add to inflation. So, views and sentiments, other views and sentiment then. So JP Morgan, August 3rd, they put out this little infographic that they had on August 3rd, saying that US equities price in 50% probability of recession currently, down from 90% on June 16th at the bottom of the equity market. So remember when we had the Federal Reserve looking for 75 basis points of hikes from the original 50, or from 50 and then jumping to 75 with the inflation soaring again when we had seen 1 month of decline. And then that's when you started to see that the chance of a recession with a higher probability of stronger rate hikes from the Federal Reserve had scared equity markets. Remember, high rates of interest, of course, whenever a business has to pay more for interest on their loans, or has to pay back their loans, and they're being charged more money to do that. Let's say they've got a fixed rate, then it's not favorable for stocks. So that's why you'd seen that big old scary jump of about 91% of the markets predicting that you could get you're going to see a recession, or the probability of recession being quite high. Now it doesn't say when the recession could occur, but it just kind of gives you that there was an increased probability of recession occurring. Then just the other bit there, so that's a 51% chance where it is at now. So it's still, of course, halfway there, but not as fearful. Remember fear and greed and how the markets react in a risk-on or risk-off environment. So it wasn't as strong as it was back in June. So we're kind of, still fearful of where, the economy could be headed, but not as fearful. So this piece from BlackRock, senior portfolio manager Jeffrey Rosenberg, said that this is going back on July the 8th, or the last non-farm payrolls data that we had, who said that it's a payroll report that solidifies 75 basis points at the July Fed meeting, which we had received. and saying that while we are witnessing some slowing in payroll gains, it is insufficient or not enough for the Fed, and the lack of people returning to the labor force is a serious challenge on the wage front. So the reason why I'm showing this comment that was made after the non-farm payrolls figure on July the 8th is that a stronger payrolls figure still means that the Federal Reserve, takes that on board and will factor that into whether or not they need to do a stronger rate hike or a smaller rate hike. Or maybe start or pause, right? At some point, maybe this year or maybe next year, there could be a pause in the rate hikes. But this, again, as said, it's key to understand that non-farm payrolls figures is still having a negative effect in the stock market and adding a positive effect for the currency and bond yields. Okay, so that's the reason why I've just shown that to you there. That hasn't changed. We haven't got to the point where the Federal Reserve has stopped raising interest rates. So once we get to the point when the Federal Reserve stops raising interest rates, then maybe we'll start to see a more normal market reaction where we get stocks reacting in a positive way to better than expected non-farm payrolls figures along with the dollar. But we're not seeing that at the moment as of yet. So that's why I've just kind of showing you that there, which is very important to understand. So as I said, you can't look at one figure. There's the unemployment rates, and there's also the average earnings year on year. So the last report or a couple of reports back, when it was lower than expected, we had when it was lower than expected, you had seen a bit of a positive reaction from the S&P 500. Of course, the report that we had this time around, if I bring up the deviations for you. Here we go. So it was higher than expected by 0.1% compared to the forecast. And what had happened was, so remember, average hourly earnings is another gauge or another measure of inflation within the US. Okay, this is where the Federal Reserve focuses on the potential wage price spiral. So if you start to see average earnings continue to creep up alongside a strong non-farm payrolls report, then that's going to add some further downside movement in the stock market. Remember, inflation, jobs is very key, and the manufacturing sector is very key at the moment for traders. Particularly now that you're starting to see more of a reaction from some of the releases that didn't really see a reaction, such as the non-manufacturing ISM data that we had this week as well. That's also key. A release that didn't really have that much of a reaction, but now is having more of a reaction. So if we're looking at last time, then some non-farm payrolls, we've seen about 100k deviation, where we've seen the S&P 500 see 65 ticks towards the downside after about 10 minutes of trading. So it was down 58 ticks. The NQ was down 250 ticks, and after about 10 minutes of trading, then remember that's what the bracket represents. We've seen about 256 ticks down. The YM, or the Dow Jones, had seen 103 ticks down, and after about 10 minutes of trading, it was 79 ticks down. Dollar yen had seen the biggest, what was among the biggest reactors, has seen among the biggest reactions within the currency pair. So dollar yen, dollar CAD. Of course, we had the Canadian dollar at the same time, Canadian data at the same time too, which is what we have today, right? We're not done yet with the prep. So the positive payrolls data, right, that we had seen from the US had outstripped the data that we have from Canada. Now, Canada's data was pretty bad, so that also helped the dollar to appreciate further, or seen further weakness from the Canadian dollar. Hence, we'd seen the US dollar CAD had seen a stronger reaction compared to some of the other currency pairs. But if we didn't have the Canadian data at the same time, or if the Canadian data was more positive than expected, we probably wouldn't have seen such a strong reaction to the dollar CAD. Probably would have held on to the dollar yen as having seen the biggest reaction compared to everything else in the currency space. So cable, of course, so cable being third in place there. If we're looking at other areas too, so gold had seen about 131 ticks down, again indicating that when you do get a strong payrolls figure or employment data, it's bearish for gold. And then the 2-year bonds as well. So you see here where the shorter term rates are seeing a bigger reaction compared to the longer term rates, right? So for 2-year, they're seeing about 53 ticks down. After about 10 minutes, there's about 58 ticks down, okay? From the beginning of from the 10 minutes following the release. And the 30-year bond had seen about 30 ticks down. And then it was, there we go, yeah, 30 ticks down. After about 10 minutes of trading, is down by about 39 ticks. So your 2-year bonds, bond prices, remember, so if you do get a better than expected non-farm payrolls data, bond prices would head lower, okay, and bond yields will naturally go higher, right? And then for your indexes, if you do get an overall really strong non-farm payrolls report, I think, from our side, we will look for, in the past, we're seeing more of a reaction to a smaller deviation from what we had in the past, around 100K on the non-farm headline figure itself. We'd want the average hourly earnings to also show a tick up as well to kind of support the dollar's strength. And you'd also want the unemployment rate, either to remain unchanged or to actually go to 3.5%. You don't want that, you kind of don't want it to kind of tick higher. Otherwise, you get a mixed bag of a reaction from the markets. So that's the deviations there then. We've got the video of what I want to show you too. So non-farm payrolls from last time. So this is about 10 seconds before the release for July the 8th. Kind of some kind of ticks right going there. Okay, so you've seen the dollar yen react instantly to a higher than expected figure. S&P dropped off of that figure, right? So there's an initial, that dropped down. GP CAD, kind of a mixed bag reactions. Remember, you had the other better data too for Canada. So you had the Canadian employment change, which was much lower than expected. Okay, but you can still see there was a nice, beautiful reaction from the dollar yen. I kind of skip ahead, and then we can kind of see, you can see there you go. That's the bond there, the 2-year bond. You can see that kind of it held it, sort of sustained its move towards the downside, as did the S&P. Dollar yen held its position, held its move towards the upside, was continued to move up. If I keep going, kind of skip through. There we go. Okay, and then that's when traders started pricing in the expectation for a 75 basis point hike even more compared to prior to the release. All right, so that's showing you the non-farm payrolls data there, the reaction that we had. I'll pause the video there. So overall, that's the reaction we had seen from the market. All right, I'm sure people have a lot of questions so far. I'm going to get through the Canadian prep now for you, and then hopefully I can answer your questions. So let me get it out of the way. We'll bring that up here. All right, let's go for the Canadian stuff then. Okay, so very, it's basically the same as the non-farm payrolls when we're looking at the definition and how it will affect the markets. Of course, there'll only be a slight difference with, of course, what the Bank of Canada have said and what the government have said. So same thing as the changes, measures the change in new jobs being added, including both full-time and part-time. Kind of skip through this. Same thing with the market reaction. Currency would appreciate if you get a much better than expected figure for the Canadian employment change. Bond prices, okay? You've got to think about supply and demand. So when the economy does really well, bond prices are usually quite low and the yields are quite high because people are more interested or invested in risk assets such as stocks. I know somebody had a question about it here. So that's what I'm kind of alluding to there for you. And then for stocks in this tightening environment from the Bank of Canada, better than expected employment change data can cause the Toronto stock index, or the TSX, to see a move towards the downside rather than towards the upside during a normal environment where the central bank isn't looking to tighten interest rates or monetary policy. Somebody said that, so what happened to the dollar if China escalates its threat to Taiwan? So think of the same thing with, actually, let me hold on to that after the data has come out, because we're going to have to delve into that in a bit more detail. But just briefly, think of it like the Russia-Ukraine conflict, like that. I'll go into a bit more detail later on about that. So hold on to that. What if I can pin this? Yeah, I can. Okay. Right. So the previous report. So last month, the Canadian labour market showed symptoms of significant tightness, with the jobless rate falling to a record low, wage growth increasing, and a large number of Canadians dropping out of the labour field, or the labour workforce. So remember the job market is still quite tight. You'll have a lot of people kind of jumping between different jobs because one job will offer a higher wage. So there's also that we might experience a lot of jobs there as well. And that's something, or the people, we see Canadians just dropping out of the labour market altogether, because some businesses might not be able to afford a higher wage for new people or new workers. So that's also one thing too. So that was the previous report. Where is the economy at the moment? So inflation, the highest since 1991, or around above 30-year high at 8.1% versus prior 7.7%. GDP quarter-on-quarter annualized at 3.1% versus a prior of 6.7%. Employment change, as we've already gone through now, which was much worse than expected, at minus 43k versus a prior of 39 and 39.8k or 40k. The unemployment rate ticked down to 4.9% versus prior 5.1%, so much better than expected there. GDP wasn't as great as it was last month, so GDP month on month we had this month was at 0% versus prior of 0.3%. And the Canadian S&P manufacturing PMI, which tends to focus on smaller businesses rather than all the big businesses, shown a tick down to 52.5 versus a prior of 54.6. So still in the expansionary phase for the Canadian manufacturing sector, according to the S&P, which used to be the market manufacturing PMI data. The triggers then for the employment change. So economists are looking for a high estimate of 45k with a low of minus 46.8k. The unemployment rate with a high estimate of 5.1% and with a low of 4.9%. So again, there's not really a lot to go through with the Canadian stuff. It's very simple, exactly the same as the same reaction you would get with the non-farm payrolls. All right. Then one thing I do want, of course, with the Canadian employment change, remember the median estimate is 15k, and then if we're looking at the unemployment rate, the median estimate is 5%. Okay, from the prior of 4.9%. Now, looking at some of the sentiment and views, so you had the Bank of Canada saying the Canadian economy is overheated. This is the last rate decision. The Canadian economy is overheated and labour markets are tight, causing wage increases to accelerate. Businesses are passing on high costs to consumers. The baseline growth prediction through 2024 does not predict a recession in Canada. So the central bank is going to continue to raise rates and tighten monetary policy, knowing that, having the belief that, doing that won't cause a recession. But they said themselves back on July 13th that they miscalculated inflation, basically, saying that they didn't factor in some of the stuff like some of the higher energy prices from the Russia-Ukraine conflict, which is a bit, of course, takes away some of the credibility. But that's when they went for a 100 basis point hike, to try and get over the hump. try and rein in some of that credibility as much as they could. But that's the Bank of Canada's view, what they had on July 13th. Then investment bank views, though, so Citi sees the employment change at 30K. That's a deviation of 15K. The unemployment rate, seeing it heading down by 0.1% to 4.9%. Bank of America sees the employment change at minus 30K, with the unemployment rate with the unemployment rate actually ticking up to 5.1%. BMO sees the employment change at 15K, so more or less in line with the median estimate then from other economists, and the employment rate to remain unchanged at 5% as well. So and that's also in line with the forecast too of 5%. All right, so now that we've gone through some of that, so that is basically everything that I kind of need to show you guys. If I get my tick strike running, I am going to go through some of the questions about Taiwan as well. That is something that has is having an effect in the markets overall, sentiment wise. So New Zealand dollar, GBP, USD, JPY. I need to get some of my Canadian data. So whilst I'm kind of going through tick strike, so I'll kind of run you through. So tick strike allows you to listen to order flow in a bunch of different things. So we have forex, crypto, futures, stocks, and we're adding to stocks quite a bit. We're still adding more stocks, ETFs and ETNs, and also internals as well. So your VIX, your ADD, your advance and declines. Those tickers are also there as well. So I just need to get the Canadian tags on here. GBP. See what we got. So what I'm doing here is I can kind of change the level of sensitivity if you're not sure what this is. So one being the most sensitive to market reactions. Basically, if you're seeing a little bits of selling or buying going on, you'll see the market, or you'll see tick strike kind of popping off here. But if you want to kind of increase or decrease the level of sensitivity when there's only a big amount of momentum that is going on within the market or the instrument that you're looking at, or maybe a certain set of currency pairs, then you can slide that up to level 15, which is the least sensitive. So again, only when there's a big amount of momentum will you see tick strike go off or give you a visual alert. It also gives you an audio alert. I've got to turn off at the moment, otherwise you'll be hearing it all the time throughout here, which will kind of distract you from the prep. I don't want to do that to you guys. But you can, it kind of depends what you want to do, how you want to trade it, how you want to trade, and how you want to use it. Some people use that as a way to manage their risk if they see a lot of buying or selling momentum, in a certain asset or assets, or a certain set of currency pairs. Or they can use it to capitalize on potential trades. If you're a scalp trader, that is also, tick strike can also be useful for that. Of course, have a play with it, fine tune what works for you, and then you can kind of see, as I said, what works for you. So this is why we want to give you a 7-day free trial of tick strike, and there we go. That link is in there for you. 7-day free trial for you of tick strike. Have a little play with it and see how it it helps you. I think I want to put let me put GBP CAD, because I know dollar CAD is going to have it's going to be more focused on the US data rather than the Canadian data, if we do get some really strong figures from the US or strong big deviations from the US. So I'm going to bring up GBP CAD. If I look at the deviation last time for the Canadian employment change, that's what I can show you there. Let me close tick strike for now. So this is data from last month. So you can see that the dollar CAD was reacting to not only a strong non-farm payrolls data, but also a weak employment data from Canada too. So you'd seen about 65k deviation there, right? Where you'd seen a depreciation or a reaction from the Canadian dollar, or depreciation from the Canadian dollar overall. So we're looking at around, a 70k deviation from, around 70k deviation from the Canadian employment change data. Alongside, you'd want the, so you can see here, although it was a bit more of a mixed bag, you'd want if you want the Canadian dollar to go up, you'd want at least around a 70k deviation on the employment change. You'd want the unemployment rate to tick down as well, and then the average hourly earnings to kind of tick up as well. So you'd want to see that kind of go up. But those are the two main figures that will kind of help decide which way to kind of go. So this is the reaction from last time. Remember, these deviations are provided with macro race, and you can have a look at this in a bit more detail. But the biggest market reaction came from CAD JPY. So let me bring up CAD JPY instead of GBP CAD. CAD JPY. The only reason why CAD JPY would have seen a stronger reaction is because the Bank of Japan has kept their easy monetary policy, and they've been, they're unwilling to raise rates or tighten monetary policy. So they're, the currency, or any currency with the Japanese yen, is seeing more volatility because of the, compared to an easiness, the easing of monetary policy from the Bank of Japan compared to every other central bank looking to raise rates and tighten monetary policy, puts the Japanese yen at a disadvantage compared to some of the others. So that's why you would have seen the CAD JPY see a bigger reaction. Like I said, okay, we've got about 3 minutes or less than 3 minutes left now till we get the data. But like I said, so look for around 70k deviation either way for the employment change data for Canada. And then we'd also want the unemployment rate to also tick down as well to really support some the Canadian dollar strengthening. But of course, for the dollar CAD, if you do get strong Canadian data and strong US data, that's where the dollar CAD is going to become a bit trickier to trade, probably, because you have two strong bits of data kind of colliding together. So which one do you take? Do you take the US data over the Canadian data, or do you take the Canadian data over the US data? So I think I'm going to keep my eyes on CAD JPY for now. I'll tell you what, I'll keep up dollar CAD anyways, just in case the Canadian data blows it out of the water and the dollar and the US data is horrendous for whatever reason. But like I said, macro race, we've got about a minute and 40 seconds. So macro race, what we do is provide you with deviations, the week ahead of what to expect, so in the different sessions, the releases that we'll be covering, and you can sign up to the mailing list to stay in touch with myself as well. So I send out one email every Sunday, which also includes the preview or the live streams for the upcoming streams that I'll be doing as well for that week. So that's also included. I've put in the link for you to be able to join that. Join us then, the mailing list. We've got about a minute left. Okay, so like I said, at least 100k deviation for the US data for the employment change, non-farm payrolls. We'd want the unemployment rate to either tick down or remain unchanged. And we would also, to get some really, really strong reaction from the market, you'd want the average earnings year on year to see a tick up as well. That's for the dollar reaction. Of course, the S&P could go see what it's seen last time. It could head down if you do see really strong non-farm payrolls data. Alrighty, is everyone ready? Got about 20 seconds, my children. 20 seconds. Don't know why I called you my children. We've got 20 seconds left. Sorry. 10 seconds. Still waiting on the Canadian US data. 528k, 528k, much higher than the forecast of 250k. Smashed it right there. So you can see the dollar moving towards the upside. Let me check the S&P. The S&P 500 going down. Catch with like a gold going down off the back of that there. Where's my tick strike? Whoops. I'll bring it up here. There we go. Okay. All right. So with the Canadian employment data, then Canadian employment change minus 30.6k, minus 30.6k, lower than the forecast of 15k. The unemployment rate for the US at 3.5%, so it did tick down to 3.5% compared to the forecast, lower than the forecast of 3.6%. Canadian unemployment rate 4.9%, 4.9%, lower than the forecast of 5%. Average earnings year on year ticking up to 5.2%, 5.2%, higher than the forecast of 4.9%. Private payrolls for the US ticking up to 471k, higher than the expected 230k. Average work week hours ticking up as well to 34.6, higher than the forecast of 34.5. Average earnings month on month, 5%, higher than the forecast of 3%. Canadian participation rate 64.7%, 64.7%, lower than the forecast of 64.91%. Manufacturing payrolls 30k, higher than the forecast of 20k. US labor force participation 62.1k, lower than the forecast of 62.1%, lower than the forecast of 62.2%. Canadian average hourly earnings year on year 5.4%, lower than the forecast of 5.9%. All right. So, well, that was some stellar data then from the US. So let's have a look looky here. If I just copy this over. Okay, within July, completely crushed it. Let's do this 230k, and the actual was 528k. Wow, okay, so that was nearly a 300k deviation, right? I'll bring it up. I am doing the other figures too, so if you do see some of the old figures, ignore all of this at the bottom. But the headline figure there, nearly 300,000 jobs, or 300,000k, 300k deviation from the forecast figure compared to the with the actual figure, or the difference between the actual figure and the forecast figure. So completely smashed it. KBB says, why is ES dropping with positive jobs report? So if you kind of scroll back to the beginning of the video, but I'll explain it now. So remember, the key thing is the positive jobs report during a tightening phase of the central bank, they're looking for strong positive data to tighten interest, to hike interest rates much higher than they would in the past, and to tighten monetary policy more, or to confirm a very strong rate hike. So of course, when a rate hike occurs, that's not favorable for stocks. So if you have non-farm, of course, non-farm payrolls being, at the top of the US economy, showing, how well the US economy is doing, that if you do get a much stronger than expected data, of course, there'll be more people that'll be, able to spend their money on goods. Jobs and businesses are able to add a load more jobs, to the economy, right? Which shows that there's also a healthy pickup in the productivity of those businesses. So a stronger economy plays into the hand of the central bank tightening monetary policy, which stocks don't like. That's why the S&P 500 went down, right? Hope that made sense to you there. But you can also look at the rest of the video too. But yeah, so let's look at the Canadian data. I know KTPY. Okay, so let's see. So Canadian employment change. Okay, that kind of ticked up. So Canadian unemployment rates ticked down, or was ticked down to 4.9%. So it was better than expected. The employment change data itself wasn't that that good. Fair. That's about a 40k deviation. So doesn't meet the 70k deviation that we were looking on either side, but still isn't good. But it is better than the prior figure though. If we're looking at there, average hourly earnings tick down. I need to look at some other areas too. So gold tick down. So let's look at the 2-year note for the US. Oops. Right, yeah, that died off. So bond prices died off. KBB says thank you. It finally makes sense. Good. Glad that helped you there. Now, of course, where you saw the data is was some kind of like opening up some of the other charts to look at, and for of course the GBP CAD and some of the other Canadian currencies or currency pairs. So financial juice is where you get the real time voice and text service for the economic release. And that's where not only for economic releases do you get real-time news, but also for any other things that are occurring within the economy. So if it is to do, or the global economy, or maybe what central bankers are saying that could have an effect on the global economy. So maybe it's from Bank of England's pill, or what Bob's Burgers, or Paul Santos was talking about was what will happen to the dollar if China escalates its threat to Taiwan. Well, of course, think of it similarly to the Ukraine-Russia conflict, when you have the, when there is a risk-off environment that is created. We'd seen when there's escalation of war or conflict, that you'd see the dollar seeing appreciation, gold seeing appreciation, crude oil prices, skyrocket. Of course, you'd have two conflicts going on then. So you'd have, of course, at the moment, Russia and Ukraine, and then China adding to that fire as well. So you'd see more of a risk-off environment from the markets, and that could help the dollar see some movement towards the upside. Unless the US gets involved in the conflict, then I think that that could be World War III. If you see them physically, go on boots to ground in Taiwan. I don't see that happening. If they ain't doing it with Russia, Ukraine, they're going to do it with China and Taiwan. That's too much. That's one big scenario, or the very worst case scenario that could happen then. But all of that news you can get here on Financial Juice Pro on the website. So you've got your news feed, just make it a big screen. You've got your voice here. We need to know market risk, or as we can see here, so US rate futures price a 62% chance of 75 base point rate hike in September, post the payrolls versus 40.5% just before. So you had some markets, or had some traders that were looking for maybe a 50 base point hike at the September meeting, but non-farm payrolls again plays into the hand of the central bank. So now markets will be probably pricing that in of a 75 base point rate hike until we get the meeting in September. But yes, so let me provide you with a 7-day free trial. Well, let us, not me. Let me provide you with a link for a 7-day free trial of Financial Juice Pro, which is there. I'm going to pin that so you can see that there. Message is pinned. Okay, so 7-day free trial of Financial Juice Pro. You can have access to that. Have a little play with it. Voice and text feed, live news service that you have. Of course, real-time data as well. And if you have, you can also put in real-time economic triggers. So if you did want to buy, let's say the dollar, ignore this figure here. This is just showing the forecast figure. You can put whatever figure you want there. But you can set your triggers for the economic releases, and once it's all saved, then if the figure matches your trigger, it will either show you a buy or sell sign depending on what you want to do in real time as soon as the data comes out or coinciding with the data. So that's also another thing to bear in mind too. All right. So that's that there. Also, we have other areas too. So of course, don't forget to like and share this video with people, your fellow traders. Make them aware of Macro Ace. If you found this useful, let them know it's been useful for you too. If it's not been useful, let me know. Send me an email, in which you can send me an email at tony@financialjuice.com. You can, let me know what I can improve, what I can change, what I can add, what I can remove, and so on and so on. That email is there. I've just posted that in the chat too. S&P is continuing to die, so I presume the NQ and the YM are also going to be dying too. They're not going to have a beautiful time. Yeah. All right. YM. There we go. Okay. But yes, so all right, so that's there for you. You can get the 7-day free trial of Financial Juice Pro. What else? Oh yes, and also we have unusual activity. So if you like trading unusual volume activity in stocks, then you can join the free beta test group of our new service. So if you like, I said unusual activity or spikes in stocks that don't really see a lot of spikes happening, then there you go, unusual activity. So join us there. If you're a stock trader, you can definitely jump on that too. We're looking to do Forex as well, maybe there's some of the other assets, but stocks is what we have so far. But do let us know, and that is free as well. So jump on that, give us your thoughts and opinions, and let us know what we can kind of improve, change, and make better. Other than that, that is it from Macro Ace. Thank you very much. I hope you enjoyed and found the information useful. But for now, so long, farewell, auf Wiedersehen, goodbye. All right, I will see you next time. All right, take care.